Good morning and welcome back to Almus Market Mornings. A shift in holiday has resulted in Indian financial markets and banks being operational, at least in Mumbai. So here we are on the NFP day, and it's the day markets could possibly get some feedback over the current pricing of rate cuts. It started with a weak NFP last month, along with revisions built up as Chair Powell highlighted the shift in the balance of risk. And then starting this week, the precursor data points to the NFP highlight a continued weakness in the labor market. Currently, markets are pricing a quarter point cut by Fed in its September meeting and 5 quarter point cuts till the end of next year, bringing the terminal rates to 3%. Of course, all could end well if things are around expectations, but let's discuss whether there is any possibility of deviations which could trigger moves. Good morning, JK. Can you break down today's job number and what it would mean for currencies and the rate market?
Good morning, Swaraj. Yes, the rate cuts up to 3%, what you indicated, would make nobody more happier than Mr. Trump and US administration because the government wants a lower rate for financing its huge debt, and possibly this data today on non-farm payrolls opens the gateway for that. However, I would personally remain a bit cautious going forward. Would not like to anticipate too many rate cuts because the tariff price pressures will eventually, have its impact. And the as per the survey in ISM, many of the manufacturers are still saying that they will begin to pass on the higher costs in the coming months. So it's not then it's smooth, it's not going to be a smooth sail for the rates. But yes, we will start off the rate cuts in September, and we'll take one month at a time, or one meeting at a time, depending on the data that is coming. But speaking of data tonight, the jobs market number to be published by the Bureau of Labor Statistics. This is the first report after the previous chief of Bureau of Labor Statistics was removed from office after huge revisions that happened in the previous month's data. Now, the month's number is expected around the same number as last month, around 73,000, and unemployment rate slightly tick up to 4.3%. The big revision is coming in the wage pressures on year-on-year basis, and that is seen lower uh, because now actually employers are beginning to call the shots. Jobs are difficult to find. As we have seen this week, the job openings have been lower. The job quits have been at 2% compared to 3%. I mean, the lower job cuts means that people don't want to quit their current jobs. While ADP was, 54,000, not too much lower from expectation, it is also on the lower side compared to the average number of jobs created during the year. Then we had the job cuts data, which came at almost 86,000 in August. It is up 39% from what number announced in July. And so far this year, companies have announced almost 9 lakh job cuts, the highest since the pandemic year of 2020. Jobless claims also jumped by 8,000 this week. This has been a 3-month high. Now, all these leading indicators to the job numbers which is due today indicate that the number will be weak. It's not as though even if the number does come marginally higher than what is expected, overall picture on the job market is definitely because that everybody agrees. In fact, the Beachbook survey, which the Fed conducts yesterday, they are also, for many companies or many districts, they reported that wages were falling, and wages were failing to keep up with the rising prices, which means that inflation is on the higher side. And they also noted that the firms were hesitant to hire workers because of weaker demand or uncertainty. So all said and done, today's number will be a dovish number almost, and leads to a rate cut when Fed meets on 16th September. Of course, before that, we'll also have another monthly inflation number The markets took these numbers, or rather these anticipations, quite positively. The risk sentiment has been quite upbeat. Once again, in the US, the S&P 500 and Nasdaq both ended at new highs, and seems to be no concern about the historical data of September, which shows that S&P has by and large given a negative return over several decades. And the notable move, what we have seen in the last 2 days, is the fall in the yields. For 30-year yield in US had reached almost 5% a couple of days back, and it is now at 4.85%, 15 basis points fall. And even the 10-year has fallen by about 13 to 14 basis points, so quite a drop there. And this also helped, more than the US, it has also helped the economies of UK and Japan, where the money markets had come under tremendous pressure due to fiscal problems. However, this has led to the yields falling there as well. So we are entering the job data with a very positive setup in the markets. Currencies have remained on the sidelines. Most of the currencies have been ranging. That could be more due to profit taking, particularly euro and GBP, and to some extent in gold also. All of them look a bit overbought, but no change in the view that the medium-term weakness of the dollar will continue. Also, let me say this, that while gold has been really leading the way, or rather, I would say has been leaping almost every week. And this week we made a high of 3578, also an all-time high, not too far away from 3600. No, but the gold's rally, which in other words indicates dollar's weakness, is not leading the other currencies. So for the currency market, the ballpark is the euro. So if the euro breaks 1.1850, you can safely assume that will be the leading indicator for other currencies to follow, particularly the major currencies like yen, GBP, and of course even the commodity currencies, and eventually it will be followed by Chinese yuan and EM currencies as well. So watching closely on the euro movement in the after the jobs data. Now coming to India. Markets have been mixed on the sentiment, but slightly on the weaker side, no doubt. As we have said repeatedly, any positives from the global or the domestic markets is not really helping the Indian financial markets, particularly the currency. We did have a couple of stab below 88 in the week. That's based on some accumulated flows, but now it seems like a demand is quite dominating below 88. Yesterday we saw the market jump to almost 88.20 from below 88, and this is because the tariff related pressures are likely to remain. Whatever the measures the government has been taking is more towards improving the domestic consumption, and also perhaps other macro external measures will take some time to reflect. Meantime, market is also looking at some statement from President Trump, where he hinted at phase 2 and phase 3 of what he calls the sanctions against India, highlighting that his past warnings had got big problems into the Indian economy, and it will result in big problems to the Indian economy if it did not stop buying from the Russian oil. So that is something that the market is taking note of. So, of course, we also had the first and a very rare official reaction on the falling rupee from the Commerce Minister yesterday, being asked if it worries him. He has actually said that government is monitoring the situation, and they were confident that things will go back to normal in the near future. But then this is a very generalistic statement. We'll have to see. Currently, the trend is higher USD INR, weaker rupee, or perhaps 88.30 breaks, 88.50 comes into play, and perhaps 89 also. This will come quickly if the dollar index also rises for any reason, after the jobs market due to either profit taking or slightly higher number, leading to some up move in the dollar index, can lead the USD INR also higher, above 88.50. However, we have to really wait and see what is happening on the trade front. The important thing could be the negotiations, and how whether the Russian oil related tariff will be removed eventually or not. Okay, thank you.
Thank you, JK. And I think markets would be awaiting the jobs market. Precursor to that, as JK mentioned, has been weaker numbers on all counts. One thing to remember though is that even though this number is weak, any overestimation of the kind of rate cuts that can materialize need caution, because the ISM survey indicates manufacturers will pass on the higher prices in a few months' time, and that's what we are seeing. We saw even a higher PPI a few weeks back. So there is still going to be a concern on the inflation front, especially when it comes to the tariff-related price pressures. This would be the first NFP tonight under the new BLS chief, expected at 70,000 jobs, and unemployment rate at 4.3%. Wage pressures are expected to be lower. A risk sentiment, though, going into NFP has been positive. US equities doing well at new highs. There's been fall in yields, 30-year and 30-year falling by 15 basis points. 10-year falling by 13 to 14 basis points. Money market pressures in UK and Japan has also eased after the fall in the US. Currencies largely remain range bound. For India, market sentiment has been mixed. Yesterday, we saw equities rally on the back of the cuts announced by the government in GST, but that also quickly fizzled out towards the end of the day. And positives on the global or domestic markets are not helping the rupee. There were moves below 88, but the dollar demand is strong below those levels, and the rupee weakens quickly. That's it from us today. Thanks for listening. Have a very good weekend. Now that the holiday has shifted to Monday, we'll catch up on Tuesday. Unless there are some major updates, we'll catch up on Monday as well with the fresh round of updates. Thanks for listening.